In this example, we are looking at general journal entries for stock dividends. We have Ames Corporation, and they have 30,000 shares of its own $1 par value common stock outstanding. And we are going to prepare journal entries to record the following transactions as they relate to the company's stock. On July 17th, the company declared a 10% stock dividend on common stock to be distributed on August 10th to stockholders of record on July 31st. Market value of the stock was $5 per share. So in this example, we have our three dates. We have our declaration date, our date of record, and our payment date. On July 17th, that is our declaration date. So on that date, Board of Directors said we are going to pay stock dividends to our common stockholders, and we're going to pay 10% stock dividend. So this is different than cash dividends. We're going to be issuing more stock instead of issuing cash. So the way we're going to calculate is for our stock dividends, it says that we have 30,000 shares outstanding, and we're going to give a 10% stock dividend. So 30,000 shares times 10% says that we're going to issue 3,000 shares of stock. So instead of giving them cash right now, we're going to just issue them more shares of stock. And they are par value, and our market value at the time was $5 per share. So our debit to our stock dividend is going to be our 3,000 shares times our $5 per share, the market value. So the stock dividend account is always recorded at market value. So that's $15,000. Now our common stock distributable is always going to be recorded for the par value. So 3,000 shares times our $1 par is 3,000. So any difference here will be credited to the additional paid-in capital account. Then on August 10th, we're going to distribute the stock dividend that was declared on the 17th. Notice that there's no entry required on the 31st because that was our date of record. So on the 10th, we're basically just we have common stock distributable, the amount that we're going to distribute. And now on the August 10th, we are ready to distribute it. So we're going to take it out of our distributable account and actually credit our common stock account for the $3,000. Then on September 1st, we're going to pay dividends. And it says we're going to pay 50 cents per share of cash dividends on the common stock that's outstanding. So keep in mind that September 1st is after we have distributed a stock dividend. So not only do we have the 30,000 shares we started with, but we also have the 3,000 shares that we issued on the 10th in our stock dividend. So we now have 30,000 shares issued and outstanding times our 50 cents per share gives us a cash dividend that will be paid out. On September 1st, it's just the declaration date. So we're going to debit dividends and credit dividends payable. On September 10th, there'll be no journal entry, and then on September 16th is when we'll actually pay out the cash dividends.